Inflation, the general increase in prices over time, erodes purchasing power and affects economies on a global scale. While numerous factors contribute to inflation, two of the most significant drivers are government spending and the fractional banking system. Understanding how these mechanisms create inflation is crucial for grasping the broader economic forces at play. How inflation reduces your buying power. Sure, inflation reduces your buying power by making goods and services more expensive over time while your income may not increase at the same rate. Here's how it works. The value of money decreases. When inflation rises, each dollar you have buys less than it did before. Example: if a loaf of bread costs $2 today but increases to $2.50 next year due to inflation, your money has lost value because you now need more of it to buy the same item. Fixed incomes suffer the most. If you earn a fixed salary or rely on savings, inflation eats away at your purchasing power. Suppose you retire with $100,000 in savings and inflation is 5% per year. In 10 years, your savings will be worth much less in terms of what they can buy. The cost of living increases. Everyday essentials like food, rent, healthcare, and transportation become more expensive, making it harder to maintain the same lifestyle without a higher income. Savings lose value over time. If the inflation rate is higher than the interest rate on your savings account, your money is effectively shrinking in value. Example: if your bank pays 2% interest on savings, but inflation is 4%, your real buying power decreases by 2% each year. Borrowing can become more expensive. Inflation often leads to higher interest rates, meaning loans, mortgages, and credit card debt become costlier. For example, a home loan with a 3% interest rate today might increase to 6% in the future, making monthly payments much higher. Bottom line, inflation erodes the real value of money, making it crucial to invest wisely, seek higher income sources, and adjust spending habits to maintain financial security. How to offset inflation. The only way to offset inflation is to invest in assets that outpace inflation, such as property, shares, or other appreciating investments. However, this creates a burden because it forces people to take financial risks just to maintain their buying power. Cash loses value over time. If you leave your money in a bank account, it slowly loses purchasing power due to inflation. So let's consider an example. Imagine you have $10,000 sitting in a bank account with a 2% interest rate. Even with that interest, if inflation is running at 5%, the value of your money is actually decreasing. Historically, property prices and shares have grown faster than inflation. This makes them, well, the best way to preserve and even grow your wealth over time. For instance, if inflation is 5% per year, but property values rise by 7%, you've actually gained 2% in real terms. Unlike past generations who could save their way to wealth, today's reality forces people to invest in assets, which comes with risks. Not everyone understands investing, and those who don't risk fall behind financially. As inflation drives up asset prices, property and shares become expensive, making it difficult for lower-income earners to invest. House prices keep rising, making it harder for young people to enter the market. Inflation creates wealth gaps. The rich, who already own appreciating assets, benefit from inflation, while the poor, who hold cash, lose buying power. This widens economic inequality, making it harder for the average person to get ahead. Bottom line, inflation forces people to take financial risks to protect their wealth, making it a burden rather than a natural part of economic growth. Those who can't afford to invest are left behind. The current situation. Governments play a pivotal role in inflation through their fiscal policies. When a government increases its spending, it injects more money into the economy. While spending on infrastructure, social programs, and defense can stimulate economic growth, excessive spending without corresponding revenue generation can lead to inflation. One key way this happens is through deficit spending. When governments spend more than they collect in taxes, they borrow money by issuing bonds. To finance these deficits, central banks may purchase government bonds, effectively increasing the money supply. As more money circulates in the economy, demand for goods and services rises, often outpacing supply, leading to higher prices. Another major inflationary factor is monetary expansion through stimulus policies. Governments sometimes attempt to boost economic activity by printing money or implementing stimulus programs. While this can provide short-term economic relief, the long-term consequence is often inflation, as too much money chases too few goods. Fractional reserve banking and inflation. The modern banking system operates on a fractional reserve basis, meaning banks only keep a fraction of deposits as reserves while lending out the rest. This system significantly expands the money supply, contributing to inflation under certain conditions. Here's how it works. A customer deposits $1,000 in a bank. The bank is required to keep only a fraction, say 10%, in reserve and can lend out the remaining $900. The borrower spends that $900, which eventually gets deposited into another bank. That bank then lends out 90% of the $900, and the cycle continues. This process creates multiple layers of money in the economy, a phenomenon known as the money multiplier effect. While this fuels economic growth, it also increases the money supply beyond what was initially deposited, leading to inflation if not properly managed. During economic booms, banks may lower lending standards, creating excessive credit expansion. More loans mean more money circulating in the economy, increasing demand and subsequently prices. When lending outpaces economic productivity, inflation rises sharply. The combined effect is the recipe for inflation. When government spending and fractional banking operate simultaneously without proper checks, inflation can spiral out of control. For instance, governments may finance deficits through money creation, increasing liquidity. Banks, leveraging fractional reserves, expand credit, further increasing the money supply. If productivity does not keep pace, demand surpasses supply, driving up prices. This scenario has played out historically in cases of hyperinflation, such as in Zimbabwe in the 2000s and Germany in the 1920s, where excessive money creation and loose credit policies led to economic collapse. Inflation is a complex economic phenomenon with multiple causes, but government spending and fractional banking are two of the most significant contributors. While these systems are essential for economic growth and stability, mismanagement can lead to rising inflation, diminishing the value of money and eroding economic stability. Policymakers must strike a balance between stimulating the economy and maintaining monetary discipline to prevent uncontrolled inflation.